In this video, we are going to try to learn how to prepare a provision for depreciation account and what is the meaning of a provision for depreciation account. But before we go ahead, we need to know about these words. What are these words? When I talk about depreciation is basically an expense where there is a decrease in the value of the asset. This is treated as expense and shown in other expenses account. So if I have a non-current asset, say I have a non-current asset named furniture. So every year I would depreciate this non-current asset. Let's do it with one example. Say for example, you have a non-current asset of 100,000 and you are depreciating this every year at the rate of 10%. So the depreciation per year would be $10,000. Depreciation is a decrease in the value of the asset because of use. So say this is your year one. The charge of depreciation in year one is $10,000. After I charge this depreciation, I put it in an account called the provision for depreciation account, or I would say I would put it in an account called the accumulated depreciation account. The provision for depreciation account or the accumulated depreciation account is an account where you collect your total depreciation. So depreciation is always charged at the end of the year on your remaining assets. I have said depreciation is always charged at the end of the year on your remaining assets. So your depreciation charge for the year one is $10,000. It is going to be charged at the end of the year. Say it is 31st December 2000. So on 31st of December 2000, you are going to transfer this depreciation to your provision for depreciation account. So for year one, your total depreciation that would be there in your provision for depreciation account is 10,000. Okay. Now you go to the year two. In your year two, your depreciation amount is again $10,000. Tell me, when are you going to charge this depreciation? I'm saying, when are you going to charge this depreciation? So this depreciation is going to be charged at the end of the year. So it is going to be charged at the end of the year. So the end of the year is 31st December 2001. So this on 31st December 2001, in year 2, 31st December 2001, this would go again to your provision of depreciation account and 10,000. So could you tell me the accumulated depreciation for year 1 and year 2, or the depreciation that would be appearing in your provision for depreciation account at the end of 31st December 2001. So at the end of 31st December 2001, the amount of depreciation that would be appearing in your provision for depreciation account is 20,000. Now I go to my year 3. Year 3, at the end of the year, if there is no purchase, no sales, again on the last date, I will charge depreciation on 31st of December 2002. I will charge depreciation for the year 10,000, which would go in my income statement in other expenses. Okay. The entry to charge depreciation at the end of the year is income statement debit, entry to charge depreciation at the end of the year is income statement debit, provision for depreciation credit. Provision for depreciation credit. So, this is the entry that you pass at the end of the year to charge depreciation on your remaining assets, and the amount is transferred from the income statement to the provision for depreciation account on the last date. So, year 3, your last date is what is your last date? 31st December 2002. The amount will go to the provision for depreciation account, and the total amount as on 31st December 2002 that would be there in your provision for depreciation account is 30,000. So the amount that is going to be there in your provision for depreciation account is the accumulated depreciation that is charged on your asset over time. What is depreciation? Depreciation is the charge of using the asset every year. It is a decrease in the value of the asset due to usage. So we know that depreciation is just an expense that is going to be charged every year. Provision for depreciation is the total accumulated depreciation that is collected for all the years together. So at the end of every year, you are going to charge depreciation and charge it to the provision for depreciation account. Now we are talking about net book value. What do you mean by the net book value of the asset? Say you have the cost of asset 100,000, which was your furniture, and you are at the end of year 2. So the accumulated depreciation for 2 years would be subtracted from the costs. So costs minus accumulated depreciation for all the years you've used the asset will give you the net book value of the asset up until that year. So the net book value of an asset is costs minus accumulated depreciation, which gives you the net book value. Net book value of the asset is compared with the selling price of the asset. Say the selling price of your asset is 50,000. So in this scenario, when you dispose the asset or you sell the asset, you are making a loss of 30,000 on disposal. So the net book value of the asset is compared with the selling price of the asset to find the profit or loss on sales, or I would say to find the profit or loss on disposal. So these are the keywords that you should know when you're trying to make your provision for depreciation account. So with this, we should know that what are our non-current assets? Non-current assets are something that we use for more than 1 year. It could be your machines, vehicles, furnitures. What is depreciation? It is the annual decrease in the value of your non-current assets. It is caused by usage, wear and tear, obsolescence, or many other things. Why do we not reduce the assets cost directly? We do not reduce the asset cost directly because we follow our historic cost principle, which says that the asset should be recorded at costs at which you buy your asset. So we show the costs separately, we track the depreciation separately, and in our statement of financial position, what we show is our net book value, but we show the costs, accumulated depreciation, and we use the third column to show our net book value. Accumulated depreciation, the total depreciation charged on your non-current assets to date. So, what is our ledger account basics when we are charging depreciation? In our provision to depreciation account, it would be our provision to depreciation credit, and we would debit it to our income statement. So our income statement would be debited. So this is the rule for provision for depreciation account. Provision for depreciation account is basically creating a provision out of the profits. Provision for depreciation account. So every year, at the end of the year, when we charge depreciation, we are going to write depreciation as an expense. So if it's an expense, we say our income statement should be debited. So income statement is debited. Because income statement is debited, provision for depreciation account, it will appear on the credit of the provision for depreciation account. The charge for the year will come over here. Let's start with some MCQs. Before we go to the MCQs, give me the journal entry for charging depreciation every year. So the journal entry to charge depreciation every year would be income statement debit, provision for depreciation credit. Okay, that's an MCQ. Pause, try, and then look at the answers. What is not a non-current asset? Stationery. Depreciation is recorded as an expense. Depreciation is caused by all of the above. When you're doing the video and you're trying to understand, it is always advisable that you pause the video, try yourself, and then do it. Accumulated depreciation is shown in provision for depreciation account. Why is depreciation not deducted directly from assets costs? To maintain the historic costs. The balance of the provision for depreciation account is always credit. Double entry for depreciation is, this is wrong over here. It would be income statement debit, provision for depreciation credit. So to match the column, non-current assets, something used for more than a year. Depreciation is an expense that is recorded yearly. Accumulated depreciation is total depreciation since purchase. Net book value is cost minus accumulated depreciation. Next, depreciation is the dash decrease in, it's a decrease in the value of the non-current asset. So it's a systematic decrease. That means either you follow a straight line method or reducing balance method. Accumulated depreciation is a dash asset with dash balance. It is a contra asset. That means it's going to reduce the value of the asset, and it normally has a credit balance. Accumulated depreciation or provision for depreciation account has a credit balance. Business must record their historic cost of the asset or their original cost. This is the historic cost principle. Net book value is the cost minus accumulated depreciation. Depreciation is recorded in the income statement. True or false? Accumulated depreciation reduces the value of the asset in the ledger. True. Depreciation always has a credit balance. It's false. Depreciation expense always has a debit balance. It is shown in the income statement. However, the accumulated depreciation or the provision for depreciation, it always has a credit balance. Provision for depreciation is an example of contra asset. It's true. Depreciation helps calculate the net book value. True. But which depreciation? The accumulated depreciation. Depreciation is a charge on the non current assets, even this is true. So, with this, we cover our true or false. Short answer questions. It is advisable you pause the video, try to do it yourself, and then look at the marking scheme. So we say define depreciation in one sentence. So depreciation is a systematic reduction in the cost of the non-current assets over its estimated useful life. This is the way it has to be learned. Two causes of depreciation: wear and tear, obsolescence, physical deterioration, you can say. Why do you track depreciation separately instead of reducing the assets? Because you're following the historic cost principle, which requires the asset to remain at their original cost, while accumulated depreciation is shown separately. Accumulated depreciation, what is it? It is the total depreciation that is charged on your asset. Double entry for recording depreciation, income statement debit, provision for depreciation credit. Now you are on the F part. It's a calculation based question. We always advise you pause the video, try, then go ahead. Pause, try, then go ahead. Machine is costing 10,000, depreciates 2,000 per year. I want the accumulated depreciation after 3 years. So after 3 years, that means 2,000 into 3, accumulated depreciation would be 6,000 after 3 years. Net book value at the end of 3 years would be the cost of the asset, that is 10,000. Accumulated depreciation after 3 years, that would be 6,000. So the net book value at the end of 3 years would be 4,000. Next scenario based question was machinery costs 18,000, it depreciates 20%, straight line method. I need annual depreciation, straight line method. 18,000, 20% on the costs. Annual depreciation per year would be 3,600. I need net book value after 3 years, so I will take 18,000, that is the cost of the assets. Since I need net book value after 2 years, so I will take accumulated depreciation for 2 years, that is 7,200. I would get the net book value as 10,800. Pause, see, do. Pause, try, see, correct. This should be the method that you follow while doing the short quizzes that I have set for you. Next one, this is a challenging question. A business has purchased an equipment for 25,000. After 4 years, its accumulated depreciation is 12,000. Calculate net book value. 25,000 minus 12,000. The net book value is 13,000. Why is net book value not equal to the market value? Net book value is not equal to the market value because the market value is the current selling price, which depends on many factors. So net book value is just giving you costs minus depreciation as an estimate of the selling price. So it is not that the book value is equal to the market value. Market value is based on many factors. What happens to an asset's value after we use it for 1 year? Its value will decrease. Why? Because many reasons: obsolescence, wear and tear, economic reasons. There could be many reasons for its value to reduce. Now we are going to go to prepare the provision for depreciation account. So by now you should know what is the provision for depreciation account. So we are starting about what is a provision for depreciation account. So provision for depreciation account is a separate account. It looks something like this, where we record the total accumulated depreciation on the non-current assets. How do I record the total accumulated depreciation on the non-current assets? Suppose I am at the end of year 1. So at the end of year 1, say 31st of December, I record the depreciation for the year, which says income statement is debited and provision for depreciation is credited. Say 10,000 is the amount of depreciation and it is straight line method. On 31st of December, say the year is 2000, I am going to transfer the balance. I'll take the balance closed down, or the closing balance is 10,000. And 10,000 is my first year's depreciation, which is going to be my opening balance of 2001 Jan 1 balance begin down, and this is going to be 10,000. What does this 10,000 represents? So I say my provision for depreciation account. It starts with an opening balance. This is the total accumulated depreciation at the beginning of the year. So since only the first year has been passed, so the total accumulated depreciation at the beginning of Jan 2001 is only 1 year's depreciation. Okay. Then at the end of 2001, on December 31, I will record the depreciation for the year. I would say income statement debit, provision for depreciation credit, 10,000. I will close the account for the year 2001 and my closing balance would be in 2001, December 31, my closing balance would be 10,000, which would become my opening balance for 2002, Jan 1, balance begin down. Sorry, it's 20,000. Balance begin down 20,000. So it starts with opening balance on the credit side. This is the accumulated balance at the beginning of the year. So the accumulated balance at the beginning of the year, the total depreciation is charged for 2 years. So after 2 years, in the third year, my accumulated depreciation is 20,000. Okay. If any asset is sold during the year, then whatever is the accumulated depreciation for that asset is removed on this side, and I will write disposal. So on the date of sales, I will remove the total depreciation on the asset sold over here, and I will write disposal. It means the asset is sold, disposed, and the accumulated depreciation of the asset disposed is recorded over here. We will take that clearly in the later sums of the past paper questions. Then we find the closing balance, all the credit minus all the debit, and the balance closed down, as you see, will always appear on the opposite side, that is the debit side, and the opening balance would always appear on the same side of the account. Provision for depreciation always has a credit balance, so the opening balance would always appear on the same side of the account, that is on the credit side, and the closing balance would always appear on the opposite side of the normal nature of the account. So opposite side is the debit side. So it starts with an opening balance which will always be on the credit side. It will income statement, the depreciation for the year would also be recorded on the credit side. Closing balance would always be on the debit side, and opening balance would again come on the same side of the account. If during the year you have disposed of any asset, so the depreciation on the asset disposed, the total accumulated depreciation on the asset disposed would come on the debit side. So this is a separate account which shows us the total accumulated depreciation on your non-current assets over the years. So this is the total accumulated depreciation at the beginning of year 3 on your non-current assets over the years. It helps us to keep the asset untouched. That means if I am making the asset account would always be appearing at the cost. Asset account always appears as the cost following the historical cost concept. Total depreciation is clearly visible in your provision for depreciation account. Say the cost of my asset is 100,000. Assets always have a debit balance. So I would say the cost of my asset is 100,000. So 100,000 would always be the opening balance, 100,000 would always be the closing balance if there is no asset disposed. And if I want to find out my net book value at the beginning of year 3, I would do cost, that is 100,000, minus accumulated depreciation, that is 20,000. I would minus it and I can easily find my net book value, that is 80,000, at the beginning of the 3rd year. We prepare this account so that it is easy to understand, easy to compare. We can make the financial statements very easily if I know my accumulated depreciation separately and if I know my cost of the asset separately. Historic cost concept tells us that the financial statement should have the costs stated separately, the accumulated depreciation stated separately, and then you can write the net book value. So with this, all the basic explanation related to the provision for depreciation is over. From the next class onwards, these are these 5 sums that is related to provision for depreciation, and that is something that we are going to do. These 5 sums, if you're able to do, you can solve provision for depreciation or asset account related statements in every question that comes.